Chapter 5, Theory of Production and Cost. This chapter I subdivided by 4: Introduction, Theory of Production, Cost and Revenue in the short run, and Cost and Revenue in the long run. So there will be 4 videos for this chapter to avoid long duration for each video. So this video is about the introduction of cost and production, which is 5.1. So in this video, you will learn about the introduction of cost and production, and then to differentiate between implicit cost and explicit cost, and also to differentiate between accounting cost and economic cost. And thus, you can differentiate or distinguish between accounting profit and economic profit. Introduction. This part is focused on the supply side of the market. So the agent for the supply is the producer, or the supplier, or the firm. Factor of production we recall as resources or input. Okay, it's very important in a production process. Okay, factor of production is land, labor, capital, and entrepreneur, if you still remember in chapter 1. And then what is production? Production is defined as a process of transforming all these input or resources or factor of production into output. Okay, from input and then going through transformation process or production process, become an output or finished product or end product ready to use by the customer. Okay, let's recall what is factor of production or resources or input. So we have land, labor, capital, and entrepreneur. So land is anything as long as it is a natural resource. Natural resources gifted by God in 100% original shape. It can be mineral, water, timber, tree, and then maybe livestock. Okay, for example, maybe a cow, meat. Okay, so all that resources we categorize under one, which is land. And then the second resource is capital. Capital is anything as long as human made. It can be an item from a smallest thing like paper, or bigger item like machineries, vehicle, building. As long as it is a human made, we categorize under the same category, which is capital. And then we have labor, skilled labor and unskilled labor. It is the human resource, physical and mental talents of men and women. And then we have entrepreneur. So this entrepreneur will control or determine other factor of production, even though this entrepreneur themselves are listed in the factor of production. So this owner of the firm or business, this businessman or entrepreneur will determine how much capital land they want to use, how many labor they want to use, what type of capital. So this entrepreneur will control the other resources. And then this is the resource in terms of Islamic perspective. You can read by your own. This is an extra. Production and cost. So like we discussed just now, production is a process of transforming production factor or input into goods and services. And then we have the concept of cost. So the costs are the payment to the input or resources or factor of production used in the production process. And then these input are classified into fixed input and variable input. Okay, to understand, to make a better understanding, so I write here. So you have resources, let's say here you have land, and then you have labor, and then capital, and then entrepreneur. Okay, this is factor of production or input or resources. You have 4 categories. Okay, these resources are not free. Okay, these resources are limited or scarce. Okay, so in order to use this factor of production, you have to pay them in the cost of payment for land is a rental. Okay, even though you use water, but we still call the cost for the water is rental in the same category as land, and also for the timber mineral also rental. Okay, we recall as a rental. So the land is not necessarily soil. Okay, it can be soil, it can be anything as long as natural resources. And then for a labor, okay, if you hire a labor, you have to pay them in terms of the wages or salary. And then if you use capital, you have to pay in terms of the interest rate, or we denote as I. The symbol is I. Why I interest rate? Because normally we refer capital for the bigger items like building, vehicle, machinery. So normally the entrepreneur will apply for a loan from the bank sector to buy those things. So the loan will cost you an interest rate. So that's why capital, the cost for capital is I. And then entrepreneur at the end, the reward for the entrepreneur is the profit, or the symbol is pi. Okay, so this is factor of production, and this is the factor of payment for this factor of production. And then these 3 items, rental, wages, and interest rate, are the costs involved in the production process. So you as an entrepreneur, okay, or businessman, your main concern is the cost of production. If you have your own plant, your own factory, you do your production by your own, okay, so cost of production is the most important thing, because this cost will determine how much profit you have and how much price you want to set, you want to sell. Okay, and then this input or resources here, okay, you can classify into fixed input and variable input. Okay, so let's say you have in the for the time period, you can divide by 2. Okay, time period in the short run, and then time period in the long run. So in the short run, you use both these 3. Okay, land, and then labor, and then capital. You use all the resources, okay, including entrepreneur. And then in the long run, you also use all the resources you have. So you have land, okay, labor, and capital, and also entrepreneur. Okay, and then in order to increase the number of quantity or output or total production, so remember total production, and then quantity, and also input is the same component. Okay, the end product. Okay, the things that you want to sell. Okay, in order to increase the number of quantity, the finished product you produce, you have to increase the output. So in order to increase the input, this is output, yeah? This is output. So in order to increase the output, you have to increase your input. Okay, so what is your input? This one, land, labor, capital. Okay, so let's say today you receive order from your customer, okay, to buy maybe tomorrow double or triple from your original production size. Okay, so you have to increase your quantity of production or total production. So what happened? Okay, because you have a shorter time period, maybe tomorrow, maybe in a week. Okay, so in the short time period, maybe you don't have enough time to increase the number of land. Okay, you don't have enough time to increase the number of capital, the machineries, the building that you have, okay, to order a new vehicle. So that's why in the short run, this resource, land, and also capital is fixed. You cannot alter the amount, the quantity that you have. So this one, land and also capital, is the fixed input. Okay, fixed input. Okay, the only thing you can increase for the input is the labor. So the labor you can increase if you want to increase the output. So you increase the labor input. So let's say tomorrow you want to increase the number of production from double to triple, okay, and then you can conduct interview today, okay, you conduct interview today to hire new staff, and then ask them to come for a work tomorrow, okay. So your total production will increase tomorrow in the short run, but in the long run, let's say your customer want the production, the product maybe next year, maybe next month. So you still have time to increase the number of input you use. So you have time to increase the land. You have time to increase the quantity of labor you use. You have time to increase the capital you have. Okay, you still have time to expand your building size or to buy new building, okay, new factory. And you have time to increase capital machinery to order and then get the things delivered to you. Okay, so in the long run, you can alter the amount of input all here. Okay, in the long run, you have enough time. So that's why in the long run, you have variable input only. Okay, all becomes variable input. But in the short run, you have variable input for labor, and you have fixed input for capital and land. Okay, because in the shorter time period, you don't have enough time to alter the quantity of this input. Okay, so because of in the long run you have variable input, so you have variable cost only in the long run. You have cost for the capital, labor, and land. You have cost to pay for the interest rate here, for the wages, for the rental. But all those costs, okay, refer to the same category, variable cost. Okay, because these resources are the variable inputs. But in the short run period, okay, you have variable input, which is labor, and you have fixed input, which is capital and land. Okay, so you have variable cost and fixed cost, okay, in the short run period. Sorry, this is FC. So the total cost in the long run period is equal to variable cost only. There's no fixed cost because there's no fixed input. Okay, all inputs become variable. You can change the amount, the quantity input you have. But in the short run period, okay, total cost equal to variable cost here plus fixed cost. Okay, because in the short run, you have variable input and fixed input. So you have variable cost and fixed cost. Okay, that is your total cost. And then beside total cost and variable cost also we can classify into explicit and implicit cost. So what is the difference? Explicit cost is the visible cost, the cost that you can see, the cost that you can record in your statement, the cost that you receive the receipt, you can see it, and then you paid it. Okay, you realize that you paid it. So it is out of pocket cost. Okay, and then this explicit cost is actually variable and fixed cost. This one, variable and fixed cost. So variable cost and fixed cost is the explicit cost. Okay. How about implicit cost? Implicit cost is the opportunity cost of producer own input used in the production process. Okay, so the producer, the businessman own input use. For example, maybe when you do business, you didn't rent any building or any premise. You just run the business in your house or in your family house, and then you use one room as a storeroom for your business. Okay, so you use your own input. Okay, and then you didn't pay any rental for to your parents. Okay, but in economics, supposedly you have to calculate everything. Okay, everything take into consideration, um, included in the cost. Okay, so you have to pay maybe 300 ringgit to your parents. Okay, for the room rental, that you convert to your storeroom, or maybe you use your own vehicle, or you use your personal your own vehicle, or your family vehicle, okay, to get a stock and then to deliver your product to your customer COD, and then you don't pay anything to your parents, or your company didn't pay any um, rental for the car or the cost for the vehicle. Okay, but again, in economics, you have to take into account that cost. Okay, so the cost that you not realize, okay, or the invisible cost is the implicit cost. Okay, because you use your own input. Okay, so you did not calculate the cost for that one. Or maybe this implicit cost, also known as opportunity cost. Okay, we recall back what is opportunity cost in chapter 1. Opportunity cost is the something that you forgone, you sacrifice, you let go in order to obtain another thing. Okay, so for example, maybe before you do business, you work somewhere and the boss pay you, the owner of the business pay you 1,000 ringgit a month. And then you quit the job because you want to do your own business. Your opportunity cost is your foregone salary 1,000 per month. Okay, so in economics, this one is included, supposed to be included in your cost of production, the opportunity cost. Okay, so in the next slide, I show you the example of the implicit and explicit cost. And then total fixed cost, total variable cost, we already discussed in the previous slide. Okay, so total fixed cost incurred on fixed input. So that's why fixed cost. For example, the rental, and then the interest rate for the capital. Total variable cost is for variable input. So variable input, variable cost. For example, is the cost for the labor, which is wages or salary. So cost we also can categorize into accounting cost and economic cost. So what is the difference? Let's look on the accounting cost first. So accounting costs refer to only explicit costs. So what is the explicit cost just now? Okay, explicit cost is the total fixed cost plus total variable cost. Okay, the cost for the fixed input, capital and land, and the cost for labor, wages. So this is explicit cost, the visible cost, cost that you record, cost that you pay, you realize you pay. Okay, the cost that you get the receipt or transaction or record. Okay, so the explicit cost is actually accounting cost because you record in your statement, your accounting statement, accounting pro forma statement. How about economic cost? Economic cost is the explicit cost plus implicit cost. So explicit cost just now is accounting cost, right? Okay, accounting cost refer to explicit cost. So explicit cost is the accounting cost or total fixed cost plus variable cost. But in economic cost, you have to add another component, which is implicit cost or opportunity cost. Okay, so therefore the economic cost is the explicit cost or fixed cost plus variable cost or accounting cost plus implicit cost or opportunity cost. This is not a symbol for divide. No, this is an option or another term we refer to implicit cost, which is opportunity cost. So if you realize here, economic cost is actually bigger than accounting cost because this is accounting cost and this is economic cost. Okay, so what happened to the profit? What's the difference between accounting profit and economic profit? Before that, let's look how to calculate total profit. So total profit is the total revenue minus total cost. So in the last chapter, elasticity, okay, total revenue is P times Q. P is the price per unit. Q is the number of quantity, the number of product you sell. So let's say the price is 10 ringgit and then you manage to sell 5 unit. Okay, so total revenue is 10 ringgit per unit times 5 unit. So you will get total revenue 50 ringgit. And then this total revenue is not a profit yet because you're not deduct with total cost. Okay, so the total revenue that you get, P times Q minus total cost, you will get the total profit. The profit, the symbol for the profit is pi. Okay, so pi equal to TR minus TC. So the total profit for the accounting is total revenue P times Q minus total cost in accounting cost, which is explicit cost or fixed cost plus variable cost. Meanwhile, for economic profit, total revenue P times Q minus total economic cost, which is explicit and implicit cost or opportunity cost. Or you can refer here TR minus economic cost. Okay, explicit plus implicit or opportunity cost. So the cost in economic is bigger. Okay, this is accounting cost. This is economic cost. Okay, so that's why economic profit is lesser than accounting cost. So economic profit supposed to be lesser than accounting cost. Okay, so please change in your slide. The symbol is wrong here. So economic profit is lesser than AP, accounting cost. So accounting profit, TR minus smaller cost, only explicit cost without deducting implicit cost. So that's why economic profit is bigger than accounting profit is bigger than economic profit. This is the example. Okay, so total revenue P times Q, you get 150,000. Okay, to get accounting profit, you have to minus with the accounting cost or explicit cost, fixed cost plus variable cost, or in detail, this cost. Cost of raw material, wages, interest. Okay, so the total explicit cost is 45,000. So 150,000 minus 45,000, you'll get the profit TR minus TC here. This is TR and this is total cost in accounting. So you get the profit, okay, 105,000. Okay, this is accounting profit. Okay, how about the economic profit? Economic profit, total revenue here, okay, 150,000 total revenue. You have deduct with explicit cost which is the amount of explicit cost is 45,000 or accounting cost, minus with implicit cost. Okay, the amount of implicit cost is 55,000. So total revenue here minus 45,000 minus 55,000, you will get the economic profit is 50,000. Okay, so this is economic profit. So it is clear here that accounting profit is bigger than economic profit. Okay, this one is lesser and this one is bigger. The next video will discuss about theory of production. Thank you.